A very good afternoon to all of you. As decided, in this second part of derivatives, we will be talking about options contracts. So, if you compare with futures contract, once you enter, you have a right as well as obligation to perform. However, if you take a position in an option contract in the capacity of a holder, you can choose to exercise your option. In other words, you will only have a right in the contract, you will not have any obligation. Such kind of derivative instrument is basically termed as option contract. So let us go into the details of option contract. We begin with the basics of options. Options are such derivative financial instruments that do not bind the option holder into a firm commitment. Let us take an example. X and Y enter into a contract where X will have the right to purchase 1000 equity shares in NJ Limited at a price of rupees 32 per share on 31/8/2022. So as per the contract, you have right to purchase the shares in that company. Here the contract is an option contract where X is an option holder and Y is an option writer. The underlying component in the contract is the equity shares in NJ Limited. This derivative contract is known as a call option as it provides a right to the option holder to purchase. The exercise price or strike price is rupees 32. The maturity date of this option contract is 31/8/2022. Guys, please understand one important thing. It is very important to get clear understanding with various terms used in an option contract. So in this example that you have seen, X is an option holder and Y is the option writer. So there are two parties involved in this option contract. One is the option holder, one is the option writer. So whoever is holding the right to buy or right to sell is called option holder. The counterparty who provides that right is the option writer. Here in this contract, this option is a call option because it indicates a right to buy. Now, who has the right to buy? The option holder, that is X, has a right to buy. So if it goes in favor of X, X will exercise his right. If it doesn't go in his favor, if it is going against his interest, X will not exercise this option. Let it go, let it lapse. So it is in the hands of X whether to exercise the option or not. However, if X is exercising the option, if X has the right to buy, and if X is performing, that is asking the counterparty to perform, in other words, if X is exercising his right to buy, Y will be under obligation to sell. So price at which you can buy this share is called exercise price or strike price. It is the contract price in this contract or in this option. So contract price, exercise price, strike price, all will have one same meaning. Now the maturity date of this option is 31/8/2022. So the option will be matured for exercising only at that date. Moving forward, let us try to understand something more. On the date of maturity, the option holder, that is X, has a right and not any obligation to buy such equity share. However, if X exercises his right to buy, then Y will be under obligation to sell. Therefore, the option holder is always at a benefit. The question is, if option holder is always at a benefit, you have to make the equation as win-win situation for both parties, right? And because option holder is always going to take an advantage, option holder will be required to pay a premium to the option writer at the time of entering into the contract. So For such benefit, the option holder has to pay premium to the option writer. Such premium is payable on entering into the contract, irrespective of whether the option is exercised or not. So once you want to be an option holder, at the time of entering into the contract, you have to pay the certain amount of premium, which will be the worth of the option on that date. You pay that premium, you buy that option. Now whether you exercise that option or not, that depends on the future circumstances, but you will have to pay that premium at the inception of the contract, at the time of entering into the contract. So payment of that option premium is irrespective of whether you exercise the option or not. Moving forward, what we see is options are such derivative financial instruments that do not bind the option holder into a firm commitment. Option contract provides right to option holder to buy or sell something in future at a price agreed today. Such agreed price is known as exercise price or strike price. We have discussed all these points. Parties involved in option, two parties involved in the option, one is option holder, one is option writer. Option holder is the buyer of the option, option writer is the seller of the option. Option holder is one who has the right to buy or sell. Buy or sell what? Buy or sell the underlying. You know what is the meaning of underlying? If the contract is for buying shares of Tata Motors, then shares of Tata Motors become underlying, correct? Option writer is the party who provides or sells such right to the option holder. Moving forward, options provide right to the option holder to buy or sell the underlying at a contracted price. The option holder is under no obligation to settle the option contract. The action to be taken in this regard is solely at the discretion of the option holder. The option holder will exercise such right only when it is beneficial for the holder. If option holder exercises the right, then the option writer is under obligation to perform. So I am just rapidly telling you the basic features of an option contract, so that once you are clear with these basic points, then I can take you ahead with the concepts. A lot of basic terms needs clarification at the early stage. Price of an option. Now something very important over here. See, there will be lots of terms having the word price included there. For example, market price, strike price, exercise price, option price. Price of an option is not the market price of the share. It is not even the exercise price or strike price. Don't get confused. Price of an option is not its strike price or exercise price. Price of an option is the worth of the option, price that you pay to buy an option. So the premium what the holder has to pay to the writer is typically the price of the option. Don't forget, it is the price at which you are buying the option. It is not the price at which you are buying the underlying. Price at which you are having right to buy the underlying, or price at which you have the right to sell the underlying, that is strike price or exercise price. Price at which you buy the option or price at which you sell an option is the premium. So premium that is involved in an option contract is typically the price of an option. Who will pay that price? Option holder will pay the price. To whom the price will be paid? The price will be paid to the option writer. So please try to understand this. For buying the option, the holder has to pay its price to the writer. Such price is known as premium. The writer of option will receive such premium. Strike price or exercise price is not the price of an option. So I have explained you this point very well. Don't ever get confused with this. Moving forward, call options and put options. Two types of options contract you will generally see. Call options convey the right to buy. Put option conveys the right to sell. So call option provides the right to the option holder to buy the underlying at the agreed price. Put option provides the right to the option holder to sell the underlying component at the agreed price. Call option conveys the right to buy, put option conveys the right to sell. I'm sure you people know these basic things very well. It's just at my concern to quickly brush up these basic points before we move ahead and go deeper into the concept. American options and European options are two typical styles of the options that prevail worldwide in various derivative markets. Now, it's not having any concern with the geographical region like in America or in Europe. This is basically a style of the option. American options, they can be exercised at any point of time on or before their expiry. That means with American option, they are ready to be exercised the moment you enter into such contract. Immediately it is exercisable. You can remember it this way, that Americans are matured right from the point they come into existence. Correct? So that way, the American option is the one that is ready to be settled, ready to be exercised the moment it comes into picture. Therefore, we don't use the term maturity date for an American option. We rather use expiry date for an American option. So suppose an American option is entered into today, that is on 7th of June 2023, and the option will be expiring on 31st August 2023. The option can be exercised anytime up to 31st August 2023. With respect to American option, its final date is never called a maturity date, it is called expiry date. So it can be exercised on or before its expiry date. On the other side, European options are more disciplined options. They cannot be exercised anytime. They will be exercised only at its maturity, and that maturity date will be the date on which a European option is capable of being exercised. In other words, European options are such options which can be exercised only and only at its maturity date. So the relevant date for exercising the European option is called its maturity date. The relevant date for exercising an American option could be any date up to its expiry. So let us read some notes over here. European options are options that can be exercised only at a specified date in future. American options are options that can be exercised at any point on or before a specified future date known as expiry date. Position of an option holder. In derivative market, three types of positions are generally referred for option holder and option writer. Those three positions are in the money, at the money, out of the money. In the money, it means when exercising that option is beneficial to you, your position is considered in the money. When exercising that option is not benefiting you at all, in fact it is a loss making thing for you, you will call it as out of the money. The option is out of the money. If exercising the option neither benefits you nor causes any loss to you, you call it as if it is at the money. At the money means a kind of, no profit, no loss on exercising the option. The ultimate profit loss is calculated differently, but I am talking about where you get no benefit on exercising the option, neither you incur any loss on exercising the option. We call the position as at the money. So understand simple thing. If the holder is in the money, the writer will be out of the money. If the holder is going out of the money, the writer will be in the money. If the holder is at the money, writer will also be at the money. So basically, position could be a position of gain or loss. A position of gain is what we call as in the money. A position of loss is what we call as out of the money. If exercising the option benefits the option holder, then his position is in the money. If the option holder suffers a loss on exercising the option, then his position is out of the money. When an option holder is indifferent with whether to exercise the option or not, then such position is known as at the money. option holder will exercise the option only when his position is in the money. You keep this thing very clearly in your mind. Option holder will exercise the option only when it is benefiting him, that is only when his position is in the money. I'm sure you people are getting clarity with whatever we are discussing, because these basic terms, if you are not clear with, you will be struggling ahead with questions and concepts that we are going to discuss ahead. Moving forward, what is option premium? I have explained to you. This is an upfront price payable by option holder to the option writer at the time of entering into the contract. By paying option premium, the option holder buys the option and option writer sells such option. Option premium is payable irrespective of whether the option is exercised or not. In order to decide whether an option should be exercised or not, option premium already paid by holder to writer is completely irrelevant. Now, you have been learning costing concepts, right from the beginning. Costing concepts, they convey one clear thing to you, that whatever cost you have incurred in the past is what we call as a sunk cost, and it is never considered relevant for the decision making. So what happens? Suppose I am a call option holder. I have a right to buy a particular share at 380. The current market price is also 380. So my position is at the money, correct? Because exercising that option is not going to benefit me. Suppose the market price of that option is, or I won't say like that, I would say the market price of the share is say 400. The market price of the share is 400 and I have a right to buy the share at 380. So I will see that exercising this option is giving me a benefit of rupees 20. But when I purchased the option long back, when I purchased that option, I purchased it for 25. That means the option price what I paid was 25. Now what happens? I think this way, that okay, if I exercise the option, I get benefit of rupees 20, but to buy this option I have already paid 25. So my overall loss is 5 rupees. So I should not exercise the option. It will be foolishness if we think like that, right? Why? Because if you do not exercise the option, no benefit comes to you currently, but you have already paid 25. That 25 will become your loss. You can actually reduce your loss by exercising the option. That is why at the time of deciding whether the option should be exercised or not, the premium that you have already paid in the past should not be considered at all, because it is not relevant for deciding whether the option should be exercised or not. Moving forward, gross payoff for both the parties. Both parties means option holder and option writer. This is the beginning point of the real concept that we are going to explore in options. So a call option is exercised by the holder only when the prevailing market price is higher than the strike price. The condition which makes a call option in the money is the condition where market price should be greater than the exercise price. Just now I gave you an example that I hold a call option which has strike price of 380. That means I can buy a share at rupees 380 as per that option contract, but the prevailing market price of the share is 400. So market price is 400. I have the right to buy it at 380. That is how I am benefited by exercising that option. I will exercise the call option only when the market price is greater than exercise price. See, suppose, just imagine, I have an option contract that conveys a right to buy a share at 380. And imagine that the market price of the share is 350. You know, one fine morning, I address you and I tell you, friends, I have a great news to share. I have a right, I have an option, I can buy this share at 380. You will laugh out at me because the prevailing market price of that share is 350. You will laugh at me that, sir, what are you saying? We can, without holding any option, we are having right to buy it at 350. Your option is worthless if you are saying that you have right to buy at 380. So right to buy something at a price is going to carry any value only and only when that right benefits you, right? And that right will benefit you only when you are able to buy it cheaper. That means the prevailing market price is greater than the strike price or exercise price. So don't try to mug up things. Don't try to by heart that when MP greater than EP, call option should be exercised. That is not how you should be learning. You should learn it logically that yes, I have a right to buy a share at a certain price. Prevailing market price of the share is greater than the price at which I can buy. That is why price at which I can buy will benefit me, and therefore I should exercise the option. And then conclude, a call option is exercisable when market price is greater than exercise price. Now read this line once again. A call option is exercised by the holder only when the prevailing market price is higher than the strike price or exercise price. So the condition for exercising a call option is MP should be greater than EP. If it is a put option, if it is a right to sell, suppose I have a put option, I have an option contract where I have right to sell the share at 380. If the prevailing market price is 400, why will I exercise my right to sell the share at 380 where in the open market I can sell it for 400? Then the option becomes worthless. But imagine that time if the prevailing market price is 350 but I have right to sell the share at 380, then that option becomes worthwhile. Then I will exercise the option for an advantage of that difference. So a put option is exercisable or it is worth exercising only when the market price is less than the exercise price. So the condition for exercising a put option is MP should be less than EP. Gross payoff for the option indicates the value on the date it is exercisable. It is also known as intrinsic value of the option. So simple logic is, I have a put option which is at a strike price of 380 but prevailing market price of the share is 350. So exercising this put option is going to benefit me. Benefit me by how much? If today the option is exercisable, today I exercise the option, sell the share at 380 but the prevailing market price is 350. Difference between market price and exercise price is what I will earn as my gain today. That is called gross payoff. The question is, payoff indicates my profit, but this is gross payoff. Correct? Gross payoff. This is not the net payoff. Gross payoff is basically gross profit, and that is the profit before subtracting the premium expense. Net profit or net payoff you will arrive at after subtracting the premium already paid. So let me explain this to you. Once again, I have a put option with a strike price of 380, means I can sell the share at 380. Prevailing market price of the share is 350. So I see that market price is less than exercise price. So definitely exercising this option is going to benefit me. By how much? 30 rupees. Because what will happen on settlement of that contract, the counterparty option writer will have to pay the price differential to me. I will get that price differential as difference between the exercise price and market price. So exercise price was 380 minus the market price, that is 350. 380 minus 350, rupees 30 I will get as cash in my hand on settlement of this contract. But that is my gross payoff. That is the worth of that option. That is the intrinsic value of that option on that date. Now, because that is the worth of the option or gross payoff, to get that benefit of 30, I purchased this option 3 months back by paying a premium of rupees 12. So 12 rupees was outflow from my pocket that day. That was the premium expense incurred by me. Why I am calling premium expense? Because I am option holder. I'll have to pay that premium to get that option. So because I have paid that premium from my pocket, how much premium I paid becomes irrelevant for deciding whether the option should be exercised or not. That is fine. But that option premium should be subtracted from the gross payoff. So I earned a gross payoff of rupees 30, but I purchased this option at a price of rupees 12. I'll subtract the 12. My net gain or net payoff will be rupees 18. That is how you arrive at net payoff. Now here, this chart what I'm showing, I would want you people to note it down. I want you to actually write it down. Along with my explanation, you start writing it, and once my explanation is over, I'll give you maybe a moment addition to write it down. Don't take the screenshot of this. I want you to write it so that throughout the session, this thing is, clear in your mind before we move further. Let us deal with call option. Now first tell me, what is the condition for exercising the call option? You have learned that, right? Condition for exercising the call option is, condition to exercise the call option is, you should be finding that the market price is greater than exercise price, MP greater than EP. So when you are dealing with call option, we will plot two possibilities. One is MP greater than EP, that is market price is greater than exercise price, where the option becomes exercisable. Another possibility is market price is less than or equal to. Notice this point, this symbol that I am using over here, less than or equal to, because here the call option will not be exercised, here the call option will be exercised. So we have classified the scenario into two categories, one where the option will be exercised, one where the option will not be exercised. So when the market price is greater than exercise price, option will be exercised. When market price is less than or equal to the exercise price, it will not be exercised. When the option is exercised, when the call option is exercised, its gross payoff will be the difference between market price and exercise price. So its intrinsic value or gross payoff will be MP minus EP. When the option is not exercised, its gross payoff or intrinsic value will simply be 0. Now, guys, understand one thing. Options contract will be settled through derivative market, and in derivative market, actual buying and selling does not happen. So because actual buying and selling will not happen, how do you deal with the option contracts settlement? The writer will have to pay the price differential to the holder. Which price differential? That MP minus EP. So whatever be the amount of intrinsic value, which we also call as gross payoff, that will move from writer's pocket to the holder's pocket. So for the holder, it is a positive cash flow. For the writer, it is a negative cash flow. So the idea is very clear. Don't deviate from the basic concept. Look at this. The worth of the option is MP minus EP. First, logically understand that we are talking about call option, where a call option indicates the right to buy. So if you take that example that I gave you some time back, I have a call option that conveys a right to me to buy an equity share at 380. The prevailing market price of the share is 400. So exercising this option will benefit me by rupees 20. So rupees 20, how I got that? 400 minus 380. And what was 400? Market price. What was 380? Exercise price. So MP minus EP becomes the value of that option, worth of that option, intrinsic value of that option, or you can call it as gross payoff for that option. This amount writer will have to pay to the holder. From writer's pocket, it will move out and it will come in the holder's pocket. So simple logic is, for the holder, the cash flow will be plus 20. For the writer, the cash flow will be minus 20. So when we talk about the payoff for specific parties, for the holder, the gross payoff will be, I am still taking MP minus EP. Look at this. But outside the bracket MP minus MP, I am putting a plus sign, indicating that holder will have this as a positive cash flow, cash inflow. Writer will have this as a negative cash flow. So outside the bracket, where within bracket I have written MP minus EP, outside the bracket I am putting a minus sign. When we open the bracket, minus sign affects both of these terms. So it will become minus of MP and minus into minus plus EP, correct? So minus into minus EP will become plus EP. So the term gets revised to EP minus MP. So EP minus MP will be the gross payoff for the writer, and gross payoff for the holder will be MP minus EP. So don't try to mug up this thing at all. Always look into what is the value of a call option when it is exercised. Value of call option when it is exercised, it is MP minus EP. Put that within brackets. For the holder, outside the bracket put a plus sign. For the writer, outside the bracket put a minus sign. That's all. That is how you should logically move step by step. So I'm giving you a moment. Please note it down if you haven't written yet, and let me know once you are done with it. Alright friends, as per my instruction, while I was explaining, you would have written this anyway, and plus I gave you a minute of extra time to note it down. I'm sure you all would have finished writing this. Now, if I take you ahead, we take the next scenario that begins with put option. Before I put forward anything on the screen, think about put option. What is a put option? It is a contract that conveys right to you to sell something at a future date at a price that is agreed today, but it is just a right to sell. You will exercise that right only if it is benefiting you. If it is not benefiting you, don't exercise. When will a put option be worth exercising? So take that same example. Suppose you have a put option where strike price is 380, means you have a right to sell the share at 380. If the market price of the share is 400, we will not exercise that option. If you want to sell the share at 400, you better sell it in the open market. Why to exercise the option and incur a loss? So we are not exercising the option in that scenario. However, if the market price of the share would have been 350, then the option is worth exercising. So a put option will be exercised only when the market price is less than the exercise price. So I will put two possible scenarios. One where MP is less than EP, the market price less than exercise price or strike price. Another one where market price is greater than or equal to exercise price. When market price less than when market price is less than exercise price, the option will be exercised. In the other scenario, the option will not be exercised. Now talking about the gross payoff. When the put option is being exercised, take that example again. You have a right to sell the share at 380. Prevailing market price of the share is just 350. You have right to sell it at 380. What will be your benefit? Your benefit will be rupees 30. How did you get that benefit? You get that benefit by subtracting 350 from 380. So your option value will be 380 minus 350. What was 380? Exercise price. What was 350? Market price. So the gross payoff when the put option is exercised will always be EP minus MP, exercise price minus market price. So intrinsic value or gross payoff will always be EP minus MP. When the put option is not exercised, its gross payoff or intrinsic value will simply be 0. Now, if you talk about the parties specific, what will be the gross payoff for the holder and for the writer? Same logic. The value of the option is EP minus MP. For the holder, that value comes in the pocket, and for the writer, the value will go out of the pocket. So for the holder, it will be EP minus MP within brackets. Outside the bracket, you will put a plus sign. And for the writer, it will still be EP minus MP within brackets, but outside the bracket you will put a minus sign. So eventually it will be minus of EP minus MP. When you open the bracket, it will become MP minus EP. So I'm sure this time you have understood this part as well. I'm giving you a moment, quickly note it down and then we move forward. Alright friends, I'm sure you have finished writing this whole thing. Let us move forward and let us deal with calculative examples given in question number 7. Let us read this question. It says type of option is European call option. Strike price is rupees 56 per share. Call option premium is rupees 8 per share. You are required to make a payoff table and indicate gross as well as net payoff for the option holder at different market prices. Determine the break-even point wherever applicable. Show the payoff graph. Also provide the outcome from the viewpoint of call option writer. Now, dealing with a question like this, which is very fundamental basic question, but you should be very good at dealing with this. First thing, the question doesn't give you any hint of market price. So you will classify the market price into 3 categories. Possibility number 1, that market price is less than strike price. So market price is less than 56. Possibility number 2, market price is equal to 56. Possibility number 3, then market price is greater than 56. So 3 possibilities: MP less than 56, MP equal to 56, MP greater than 56. Then, being a call option, identify in which scenario you will exercise the option. Then identify what will be the gross payoff for that option. And then from the gross payoff, subtract the amount of premium that you have paid and you arrive at net payoff. The question is also asking you to identify the break even. Break even for any option will be a price, or you can say that market price where the net payoff should be 0, not the gross payoff. Net payoff should be 0. When the net payoff is 0, then and then only the option holder is at break even. So this is the question first asked from the viewpoint of option holder, and then you have to present the view of option writer as well. So you are going to tabulate this whole thing, and because the question is not conveying any market price detail, I told you to put 3 lines separately. One will be market price less than 56, market price equal to 56, and last line will be market price greater than 56. So let me show you how to deal with it. We first take the viewpoint of option holder. So when we take viewpoint of option holder, what do we find over here? Type of option is European call option. Strike price is rupees 56 per share, which is the exercise price. So payoff table, how will you make? This is a standard format of any option payoff table, and you would always prepare the payoff table in this style. Now, because the market price details they have not given, in your institute study material, you will be finding lots of examples where the question gives a big list of market price. That if market price is 48, if market price is 50, if market price is 55, they will give you a big list of market price. In absence of any such list, you simply will be plotting the market price column into three categories: MP less than 56, MP equal to 56, MP greater than 56. Then comes the next column, action to be taken by holder. Keep one thing in your mind: whether you are talking from the viewpoint of option holder or writer, action will always be taken by the holder. Writer cannot take any action, because who has the power to decide whether option should be exercised or not? It is the holder who has the power to decide whether the option should be exercised or not. As a result, action to be taken by holder. Now, only two types of actions holder can take: either let the option lapse or exercise the option. When will the holder decide to let the option lapse? When it is not beneficial. And when will the holder decide to exercise the option? When it is beneficial. It is a call option. It will be beneficial for the holder only when you are in the third line, that is when market price is greater than 56. Because prevailing market price, if it is say 60, then it is worth exercising your option and buy that share at 56 when the price is above 56. Otherwise, if the price is less than or equal to the if the price is less than or equal to the exercise price, it is not worth exercising your option, because your position would either be out of the money or at the money. You will not exercise the option when your position is out of the money or at the money. You will exercise your option only when your position as in the position of the holder, is in the money. Don't forget that. And therefore, when you have written that chart, what is the condition for exercising a call option? The condition for exercising the call option is market price should be greater than exercise price. So in this column, it is in this line where you will write exercise. In other two lines, you will simply write lapse and lapse. When the option is lapsed, you don't have to think the gross payoff will be 0 and 0, the end. When it is this line, the gross payoff will be MP minus EP, and MP minus EP is the value of the option, correct? We have learned that in that chart. We are talking about call option. Look at the intrinsic value of the call option in the chart, what you have written. In that chart, you have written the value of call option as MP minus EP. If you are a holder, you will get that value. If you are a writer, you will have to pay that value. So because here you are a holder, you will get that value. So MP minus EP remains as it is. So gross payoff, what you have to fill in this column is 0, 0 and MP minus 56. It is basically MP minus EP. The exercise price is 56, so we are substituting that as MP minus 56. Now, premium expense will be rupees 8, because that was the premium given to you in the question. Whichever line you are dealing with, whether option is exercised or not, premium you have already paid, and that was rupees 8. 8, 8, 8 in all the three. Now talking about net payoff, the gross payoff was 0. You got nothing on settlement, but you paid rupees 8 at the time of entering into the contract. Your net payoff will be minus 8 in the first two lines, and in the last line, MP minus 56 is your gross payoff, and from that you subtract 8. You know, MP minus 56 minus 8, MP minus 64 becomes your net payoff. Last line or last column over here is the break even point. When you are definitely getting losses, means there is no chance of any break even. So break even is not applicable in either of these two lines. Break even is applicable only in this line. So what is the net payoff over here? MP minus 64, and meaning of break even is what? The net payoff should be 0. So equate the line. MP minus 64 should be equal to 0. MP minus 64 should be equal to 0. When will MP minus 64 be equal to 0? When MP itself is 64. That means MP equals to 64 is the break even point for this option. So first two lines not applicable. last line when MP equals to 64. If you arrive at a shortcut over here, how did you get this 64? It was basically the strike price plus the amount of premium that you paid. So strike price plus premium becomes a break even for a call option. Simple logic. Strike price plus premium becomes the break even for the call option. Now whether it is holder or writer, the break even remains same. I will explain this from the viewpoint of writer as well, but first you note down this whole thing. I'll give you a moment to take a screenshot. Later on in your notebooks you can write up the entire solution. Alright friends, time for us to move ahead. Let us plot the payoff graph. Now, graphical presentation is also very important. If you see in your study material, they would have given graph for each scenario. There are plenty of graphs given in your material. Understanding these basic graphs, it is very, very important. In the payoff graph, there will be two axes, X and Y. On the X axis, you will plot the market price. On the Y axis, you will plot the net payoff. Do you see this zigzag over here? This is what we call as a breaker. Breaker is important because this overrules the scaling of the graph. Now, I will take 56 because 56 is the strike price, and another point that I plot is 64, which is basically the break even. Now you know why breaker is needed. You see, gap between 56 and 64 is 8. On a scaling basis, if this gap is 8, then by measurement from 0 to 56, logically it will never be gap of 56, correct? Because 56 is what? 7 times of 8. This distance is definitely not 7 times of this distance. That is why we put a breaker wherever the scaling is overruled. Anyway, so now what we are supposed to do? We are supposed to plot the net payoff over here on the y-axis. Have you noticed one thing? The maximum amount of loss that can be suffered is rupees 8. So rupees 8 is the limit of the loss. So I am plotting that as -8. So when is -8 happening? When the market price is less than 56. Second line, when the market price is 56. Under both scenarios, the net payoff is -8. Thereafter, when the market price goes above 56, the payoff will start rising, and it will keep on increasing, and it will cross x-axis at this point of 64, and that is the point of break even. So let me plot that for you. You see, this is the break even point, 64. So what is happening over here? Up to 56 as market price, you will be definitely incurring a loss. At 56, you will still incur loss, When the market price starts going beyond 56, you start having reduced loss. When it is 64, you arrive at break even, and thereafter if the market price is rising up, you go on making profits, and there is no limit to such profit that you can make. So a holder of call option will have limited loss. If you are prepared to incur loss of rupees 8, your loss cannot go beyond 8. But the profit potential by holding this option is unlimited. So do one thing, take snapshot of this particular graph, and then I take you ahead. Alright friends, time for us to move ahead. Let us note down some important points over here. First thing what we have observed, it is observed that a call option holder makes a gain in bullish market, that is to say when the prices are rising. Let me take you back to the graph. Look at this. Look at this. When are you making a positive net payoff? When the market price is rising, correct? So call option holder will be making money, will be making gains, will be making profits when the market price is rising. That means call option holder will be making benefits in a bullish market. So the first point is, it is observed that call option holder makes gain in a bullish market, that is to say when price are rising. Break even point for call option holder will always be strike price plus premium. I have already explained you this point, and by becoming holder of a call option, you have chances of limited loss, but you have chances of unlimited profit. So quickly take screenshot of these important points as well, and then I take you ahead. Alright, let us move ahead and now take the viewpoint of the counterparty, that is viewpoint of option writer. So when you take the viewpoint of option writer, what will you notice over here? Type of option, European call option, strike price remains 56, payoff table, same format. Now notice one thing, some students generally comment and tell me that, sir, you know, there is some mistake in the table heading that you have drawn over here. I ask them, what mistake do you find? This is, sir, the heading that we have written is from the viewpoint of option writer, but you know, you have still written this as holder. Let me tell you, action is always taken by holder, whether you take the viewpoint of holder or you take the viewpoint of writer. Even if you are a writer, but you will not take action, right? Action will always be taken by the holder. So here, even though you are writer, you have to sit and wait and watch. Let the holder decide what has to be done. That is why action will always be taken by holder. So now we will have same three lines of market price. Action to buy or action to be taken by the holder will also remain same, lapse and exercise. Gross payoff will be 0 and 0 for the first two lines, but now while you write the gross payoff, now you keep in mind action was taken by holder, but you are not holder, you are writer, correct? If you are writer and we are talking about gross payoff for a call option is MP minus EP, but when you have been a writer, you have to pay that value from your pocket. It becomes the inverse, it is EP minus MP. So EP is basically 56 over here. So gross payoff will be 0, 0 and 56 minus MP. For the holder it was MP minus 56, for the writer it will be 56 minus MP. Notice one more line over here, premium income. Basically premium income, why? Because you are talking about the case of an option writer. Option writer will get the premium as income. So premium income is rupees 8. So net payoff this time will not be gross payoff minus premium, it will be gross payoff plus premium. So payoff on a net basis will be 0 plus 8, 8, 0 plus 8, 8, and here 56 minus MP plus 8, that becomes 64 minus MP. So break even will not be applicable in the first two lines. In the last line, the break even will be arriving when net payoff is 0. Net payoff is 64 minus MP, and 64 minus MP will be 0 only when MP itself is 64. So break even will be not applicable in the first two lines. In the last line you will be writing break even as MP equals to 64. So please write up this whole thing. So of course writing up over here means you just take the screenshot, you will be writing later. And before I take you ahead, I want your responses, whether you people are following or not. Quickly tell me. In case you have any point of doubt, you can put it forward. Fine, I can see that you are following everything what I am discussing over here, and you would have taken the screenshot of this table presentation by now. Let us now go ahead and draw the payoff graph. Payoff graph, similar style, but because the position is reverse, for any market price less than or equal to 56, the payoff will be positive for the writer. That is what we have seen, plus 8, plus 8, plus 8 throughout up to this. After 56, when the market price further rises, the payoff will start declining. It will decline, 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 and it will come to 0 when the market price is 64. That is where you will call it as a break even point. If the market price goes beyond 64, the payoff will go negative. This is how the payoff will be observed. And notice one thing, there is a potential of earning limited profit, but there is a chance of incurring a big amount of loss if the market price rises. So what conclusion you can draw from here? When will the option writer, that is call option writer, make money? Not when the prices are rising up. He will make money when the prices are declining. So call option writer will make money in bearish market, not in bullish market. So break even point will be when MP equals to 64. Keep in mind one thing, for call option, whether you take the viewpoint of option holder or option writer, the break even will always arise when it is strike price plus premium. So strike price was 56, premium was 8, strike price plus premium 56 plus 8 will be 64. So whether it is case of holder or writer, the break even will be 64. So please take a snapshot of this as well, and then I take you ahead. All right, once done, let us move ahead and note down some important points over here. It is observed that a call option writer makes profit when the market is bearish, that is to say when the price decline. Break even point for a call option writer will always be strike price plus premium, that is in this case it is 56 plus 8, that is 64. The outcome of writing a call option can be limited profit but unlimited loss. The Profit over here will be limited to the extent of premium that you have received as an option writer. So please take note of these points as well. Just take the screenshot and then we move ahead. All right, friends, I'm sure you have done the needful over here, and time for us to move ahead. We go to the next question, which you'll find exactly similar to the previous question. The only difference is here we are talking about a put option. You see the strike price is same, premium is same, all requirements same, everything same. Question is asking you to plot the viewpoint of holder as well as writer, and the question is asking you to make the payoff table, determine break even wherever applicable, show the payoff graph. Everything same as in previous question, and both viewpoints you have to show, that is the viewpoint of option holder as well as writer. And here I want your active involvement. So we will first take the viewpoint of option holder, and don't forget that this is a case of a put option. So the exercise price of this put option is 56. Payoff table, when you prepare, same format of payoff table, market price, action to be taken by holder, gross payoff, premium expense, net payoff and break even point. Same three possibilities I will plot: market price less than 56, market price equal to 56 and market price greater than 56. Now what I am expecting from you, I don't want you to just sit and listen to me. Use your brain, take a moment. It will not even take 2 minutes to plot these values. I'm waiting for you. 2 minutes time I'm giving you. I want you to do the needful and let me check whether you go correct or not. I will not put pressure on you to answer these points, but I'll definitely want you that at least you verify whether you were correct with this or not. So I'm giving you 2 minutes time. Your time starts now. All right, friends, I gave you a couple of minutes to identify whether you can plot the correct values in this table. So action to be taken by holder. Being a put option, it is exercisable only when market price is less than 56, that is market price is less than exercise price. So you will write exercise lapse and lapse over here. Wherever option is getting lapse, its gross payoff will be simply 0. But when a put option is being exercised, its gross payoff for the holder will be exercise price minus market price. That is what you have seen in the chart of put option. So here the gross payoff will be 56 minus MP, and in other two lines it will be 0, 0. Premium expense will be 8, 8 and 8. So net payoff will be 56 minus MP minus 8. So 56 minus MP minus 8 will give you 48 minus MP. In the other two lines it will be minus 8 and minus 8. So the break even point over here will arrive when 48 minus MP should be equal to 0, and that is possible only when MP equals to 48. For other two lines break even is not applicable. You can take screenshot of this table and see if you are correct with this, and let me know in the comment box whether you were correct with this or not. If you don't say anything, I'll presume that you are not correct. If you are correct, do mention it. All right, let us move ahead. Payoff graph. Now, payoff graph for a put option will be little different. You can see I have placed breakers on both the axes. Now I will plot two values on the x-axis, that is basically the strike price and the break even. For a put option, the break even will always be strike price minus premium. For the call option, it was always strike price plus premium. For the put option, it will always be strike price minus premium. So 56 minus 8, the break even is 48. Now the profit potential will not be unlimited over here. It will be limited to 48. Whatever be the break even, that same thing becomes the maximum profit potential for put option holder, and the maximum loss chance will be the amount of premium, that is rupees 8. Now you know what will happen when the market price is greater than 56 or equal to 56. There is a static loss, right? So that static loss line will come here when it is equal to or greater than 56. When the market price is less than 56, the put option will actually be exercised, and therefore your payoff starts getting towards positive. When the market price becomes 48, your net payoff will become 0. That is where you get the break even. And when the market price keeps on reducing, you will make profit, but your profit cannot cross the boundary of y-axis, and the maximum profit what you can get is not an unlimited profit. The profit gets limited to strike price minus premium. So plotting this line will be like this, and break even will be strike price minus premium. So keep one thing very clear in your mind. In case of put option holder, your loss will have a limit, your profit will also have limit. If you are a put option holder, your loss is limited to the extent of premium that you have paid, and your profit is limited to the extent of strike price minus premium. The way you compute break even, strike price minus premium, 56 minus 8, that is 48. That 48 will be the maximum amount of profit that you can earn, guaranteed. You cannot earn a penny more than that. Simple logic, right? Simple logic. What is your net payoff? Check. What is your net payoff in the table? You want me to show that? I'll show you. Your net payoff in the table is 48 minus MP, right? So the greater the value of MP, the lesser will be your net payoff. So if you want to maximize your net payoff, MP should be lowest possible. Now you tell me, what is the lowest possible market price? Market price cannot ever go to negative, right? So lowest market price will be 0. So if I substitute market price with 0, the maximum possible net payoff will be 48. 48 is the maximum limit of your net payoff. Your net payoff cannot cross 48. That is why in this graph it is clearly visible that 48 becomes the limit of your profit, and 48 itself will be the break even point for this put option. So this is the graph for the put option holder. I'll show you the table for the put option writer as well as the graph for the put option writer, but first you note down this whole thing. So just take a screenshot of this graph and then I take you ahead. All right, friends, I'm sure you have taken note of this payoff graph. Few important things that you should note down. It is observed that a put option holder makes profit when the market is bearish. We have seen that in graph, and when the market price is less, the put option holder will be making profit. When the price is declining, it will be beneficial for the put option holder. Break even point for a put option will always be strike price minus premium. I have explained you this, and the outcome of holding a put option will be limited loss and limited profit. This also I have explained to you. You can take screenshot of this as well and then I take you ahead. All right, let us move ahead and take the viewpoint of option writer. So for the option writer, the payoff table format remains same. Action will still be taken by holder, but little difference in the gross payoff column, and now premium will not be expense but premium will be income, and net payoff will be gross payoff plus premium income. So same three lines, same type of actions. Gross payoff for the later two lines will be 0 and 0, but gross payoff for the first line will be MP minus 56 because it is a case of put option writer. Premium income in all lines will be 8, 8 and 8. Net payoff will be gross payoff plus premium income, and break even point even for the put option writer will arise when the option is in the exercising range, that is in the range where market price is less than 56. So that time break even point will arise when market price is equal to 48, and for other two lines break even is not applicable. So take snapshot of this and then I take you ahead. Alright friends, time for us to move ahead, and now let us plot the payoff graph. This time the breaker has been placed in the lower side of y-axis because the limit of profit will be 8 and the limit of loss will be 48. This is how the payoff graph will appear for the put option writer, where 48 remains break even. Between 48 to 56 the payoff goes on rising, and at 56 you get the maximum profit of 8, and thereafter when the price rises you continue to get the maximum payoff of 8. So maximum potential of profit is limited, maximum loss is also limited. Both profit and loss will be limited. For the put option writer, the profit is limited to the extent of 8, that is to the extent of premium paid, and the loss is limited to the extent of strike price minus premium. Break even point will also be strike price minus premium, and this put option writer will make money in bullish market because the prices are rising. There will be benefit for the put option writer. When the prices are falling, put option writer will incur loss. So take a snapshot of this payoff graph, and then I take you ahead. Alright, if you have done the needful, let us move ahead and write down those important points. So put option writer makes gain in a bullish market, that is when the prices are rising. Break even point will be strike price minus premium, that is 48, and outcome will be limited loss and limited profit. The loss is limited to the amount of strike price minus premium, and profit is limited to the amount of premium that you have earned. So quickly take snapshot of these important points as well, and then we move ahead. I'm sure you have done the needful. Let us move ahead and let us write down some important points with respect to net payoff and break even. The net payoff for option holder is always equal to gross payoff minus premium. The net payoff for option writer is always equal to gross payoff plus premium. Break even point is arrived at when net payoff equals to 0. So break even point for call option will always be strike price plus premium. Break even point for put option will always be strike price minus premium. I have explained you all these points. Quickly take a screenshot of this and I take you ahead. Alright friends, I'm sure you have done the needful. Let us move ahead and deal with a question over here. Now this question divided into 4 parts. It says strike price is 47 per share, premium is rupees 4 per share. Determine the break even point for call option holder. Okay. Next question is asking determine the break even point for call option writer. Then it is asking determine the break even point for put option holder, and then determine the break even point for put option writer. When you get a question like this, whether it is holder or writer, simple logic is for call options the break even point will always be strike price plus premium. For put option, whether it is a case of holder or writer, it is strike price minus premium. So answering these questions will be just one line task. So you can just put the answer over here, and break even point for call option is strike price plus premium. So 47 plus 4, 51 is the answer for A. 129 is the answer for B. So I'm telling you again, whether it is case of holder or writer, break even point for call options remains static to strike price plus premium. In case of put option, it is strike price minus premium. So answer will be 325 for C part and 14 for D part. Take screenshot of this quickly. I'm sure you would have understood this very well. Moving forward, outcome of call option. Holding a call option provides the holder an opportunity to make unlimited profit when the market price rises up, with a risk of limited loss when the market price falls. Such loss is limited to the amount of premium paid. We have discussed this point already. Just take the screenshot of this note, which is an important note. What will be the outcome of a call option? So holding a call option, this will be the outcome. Now let us talk about what will be the outcome of writing a call option. So moving forward, outcome of writing a call option. Writing a call option creates for the writer a chance to incur unlimited loss when the market price rises up, with an opportunity to make limited profit when the market price falls. Such profit is limited to the amount of premium received. So call option holder makes money in bullish market, call option writer makes money in bearish market. Quickly take the screenshot of this as well. We have discussed all these points already earlier. Just noting down this is important. So later you can write it down in your notebooks. As of now, you just note down everything by taking screenshots. Now, a very good question asked by one of the students. I'll read out that comment. She says, sir, may I know why a person choose to be option writer when they can have only limited profit? Very good question actually. In real life, when you ever start trading in option contracts, you ask opinion from 100 experienced people, they will always give you advice, never become option writer. They will always ask you to become option holder. They will always ask you to become option holder. But see, in the market, an option contract will emerge only when there are both the parties involved, right? So, let me tell you one simple point, that I make you play a game. You are the player and I am making you play the game. I say, I throw a dice. If it shows 5, I give you 10 rupees. If it shows any other number, you lose, but then you don't have to pay anything. If you win, you get 10 rupees. If you lose, you don't have to pay anything. Good game, right, for you? But entry ticket to play this game is 1 rupee. I am making you play this game. You are the player. You pay me 1 rupee. I throw the dice. It shows 3. You lose. You don't pay anything. Game is over. You want to play one more round? Again pay 1 rupee. I'll again throw the dice. Still it is not showing 5. It shows something else. You get what? Nothing. You keep paying the entry ticket until you want to play, because I am confident that rarely it will be a case where the dice will show 5. Point is what? I am making you play the game. You are playing the game, and every time you play the game, you pay entry ticket. relate this kind of point, that option writer is a big party who is making you play a game where the entry ticket for playing this game is the option premium that you pay. Option premium you pay, suppose it is a case of put option, correct? So put option writer will be making money when the market price rises. Put option writer is 100% confident because these are experienced players in the market. They are confident that this is the point where the price will move up. That is why they agree to become put option writer. And you become a put option holder. I know that the price is going to rise. You are skeptical. I am knowing that the price will rise. Slightest possibility that price may fall and I may lose, but there will be chances of limited profit, but the probability of that chance is very high. If that is the case, I become a put option writer. You will pay the premium and you will then not exercise your put option. Whatever premium you pay simply comes into my pocket, game over, like that. So there is a reason why someone would become a put option writer, or why someone would become even a call option writer. The idea is what? Option writers also do make profits in the market. In fact, option writer who will become? Only the experienced parties become option writer. The new traders in the option market all prefer being option holders. I believe you understood the perspective, and all in the market cannot become option holder. For every contract, one side if there is an option holder, other side there has to be an option writer. You cannot find absence of option writer, and option writers do make money in the market. So that was a nice discussion, a nice question actually. So let us move ahead from here. Let us also talk about what would be the outcome of a put option. Outcome of put option. So holding a put option provides the holder an opportunity to make limited profit when the market price falls. Such profit is limited to strike price minus premium. When the market price will rise, you will incur a loss, but then the loss will be restricted to the amount of premium paid. So put option holder will make money when the price is falling. Put option holder will incur loss when the price is rising. So please take a screenshot of this as well. All right, let us take the other side viewpoint. What will be the outcome of put option when you are writing a put option? So writing a put option, there is a possibility of limited loss when the market price falls. Such loss is limited to strike price minus premium, with an opportunity to make limited profit when the market price rises up. Such profit is limited to the amount of premium received. So put option holder makes money in bearish market, put option writer makes money in bullish market. So please take screenshot of this as well, and then I take you ahead. Alright friends, I am sure you would have completed and done the needful. Next, what we have to discuss is something very vital: options valuation. See, option valuation refers to determining the fair value of an option, as in what should be the worth of an option, how much should be the premium of an option. Right? The premium of the option is the price of the option. The fair price of the option is what we call as determining the option value, or determining the fair value of the option. And determining such fair value of the option, that process is called option valuation. Now we have traditional approaches which deal with binomial distribution, and the modern approach that deals with continuous probability distribution. The traditional models, typically binomial model, will deal with two outcomes only. Modern theory, which is conveyed by Black and Scholes model, deals with multiple outcomes, that is multiple possible outcomes. So traditionally there were multiple models like portfolio replication model, borrowing investing combination model, then you have risk neutral model, binomial model. All models will result into same outcome exactly, not a pinch of difference. Thought process and approach could be different, but they will land up at the same value. Black and Scholes model accommodates various possible outcomes. It's more mathematical approach, more systematic approach, covering all possible aspects, and that is what is used in reality today in derivative market. So how option value is placed in the market? You have BSM calculators, Black and Scholes model calculators. You put the details, you will get the extract of what should be the price, and then when you see the premium of the option quoted differently, you come to know whether the option is underpriced or overpriced, and accordingly you may decide to buy or sell the option. So generally, if it is an option worth buying, it's a good move because you will end up becoming an option holder. Option holder is almost a no risk kind of tactic. There is limited risk, definitely. Risk, what you have is restricted to the amount of premium that you are paying. But that too, when you are buying an option, you are comparing the fair value of the option with what is the premium quoted in the market. Only when you find the option underpriced, you will buy that option. With this kind of option valuation strategy, your approach in options trade will get much stronger. So option valuation, how to arrive at the fair value of option. So traditional models or modern theory, that is Black and Scholes model, they have one thing in common. All the valuation models by far till date designed are meant only for determining the value of call option. Till date, there is no model which can directly independently determine the value of put option. You have to first arrive at the value of call option. Then there is a put call parity equation. There is a theory called put call parity. Through that put call parity equation, where you obtain the value of a call option, and using put call parity you derive the value of put option from the value of call option. So independent calculation is always for the call options. Through the value of call option, using put call parity, you will derive the value of put option. That is basically the structure. Now whether you are talking about the traditional models or the modern approach, both ways you will be finding that option valuation has to be done for call options in the first stage. So suppose there is a question which is asking you to determine the value of put option only, then what you will have to do, whatever be the strike price, suppose strike price is 300. So at 300 as the strike price, what will be the value of call option? You determine that first. Then use put call parity theory on the value of the call option, and through that you derive the value of put option with the same strike price of 300. That will be the process of determining the value of put option. Uh, in your exam, option valuation is having significant importance, and you will be dealing with the traditional models as well as the modern approach. Now, what happens? 90% of students that I've seen, they are blindly following the formulas and putting the calculations, and they don't even know what they are doing. Correct? Every model that you are applying has a logic behind that. Every formula that you apply has a logical derivation. You need to just understand the logic behind that, and you will be having crystal clarity. You look at the question, within 2 minutes you can answer. Those questions may carry 4 marks, 5 marks, 6 marks in exam, and believe me, time needed to solve that question will hardly be 2 minutes, provided you have that level of understanding. Even Black and School's model has a logical derivation, but because the derivation of that formula has a lot of mathematical application, that level of mathematical application where your mathematics understanding has never gone to that level, you and me who are from financial background, we will not have that edge to understand that level of mathematics, but that formula is also having a logical derivation. So when I'm dealing with the traditional models, each and every model, you talk about portfolio replication model, risk neutral model, binomial model, any model, you will have a systematic approach, you will have a systematic derivation of that formula, you will have a logical approach to that. Everything that you are doing, you will have reasons why we are doing that. And in fact, the most beautiful model over here from the traditional approaches is the portfolio replication model. In fact, portfolio replication model became the base for designing the put call parity equation. So if you want to logically understand the put call parity equation, you have to first understand portfolio replication model, and the same logic is then applied on put call parity equation. Now the content that I'm talking about is like quite huge, so I will show you some good calculation tactics, as in how you can approach a question, solve it without any error, and then we will see how you are interested to go deeper into the logics, and if you are really interested, you want to learn those logics, how to prepare that, I'll guide you on that. But this in this limited time, unfortunately I cannot do too much for you, so whatever possible in this session I'll do it for you. So let us first note down some important points that I've already discussed with you with respect to option valuation. Premium is considered as the value of an option. Option valuation refers to determining the fair amount of premium, that is how much should be the premium. On comparing such fair premium with the actual premium, one can make out whether an option is underpriced, overpriced, or fairly priced. What if the option is underpriced? Buy such option. What if the option is overpriced? Sell such option. Buying an option means becoming option holder. Selling an option means becoming option writer. So please do one thing, please take the screenshot of this and make sure that everything that we have discussed by far, you have understood this much, and then I take you ahead. Alright friends, you would have done the needful by now. Let us move ahead. Value of an option can be determined through portfolio replication model, risk neutral model, binomial model, or Black and Scholes model. Black and Scholes model is basically the modern approach. Other three are classified as traditional models. All the above approaches can be used for determining the value of call options only. For determining the value of put options, first determine the value of call option for the same exercise price, and then at the next stage use put call parity theory for determining the value of put option through the value of call option. So take the screenshot of this as well. I have explained you this, just need to note it down. Alright, time for us to move ahead and let us deal with portfolio replication model. Now what I'll do is I'll directly take you to an example and explain you how to deal with portfolio replication model, as in what you need to do to arrive at the value of an option. Okay, so what happens under a portfolio replication model? Imagine that you are holding a stock. So you have created portfolio of an individual stock. You can call it as a stock portfolio. Now you create another portfolio using options, basically using a combination of a call option and the money simultaneously invested into risk-free investments. So with the combination of those two, you can create a replica of holding the share. If the share price rises, your wealth will also rise in that replica. If the share price falls, your wealth will also decline. So the point is, what will happen when you have created that replica? You will be able to figure out what will be the value of call option that can be derived from that portfolio replication. That is the base of the model. So this model creates replica of a stock portfolio through options, that is basically call options. The stock portfolio will have or will contain a single equity share whose option valuation is required. The option portfolio on the other hand will contain any number of options to match with the stock portfolio, because your objective is to create a portfolio which will be replicating the stock portfolio. Through this created match, the value of call option can be determined. Now how this is done, let me show you by an example. So question number 17. Now when you are dealing with this for the first time, it may take a little time for you to figure out how to approach, but when you have mastered this, when you look at this question, within a minute you will answer. I can assure you that needs that kind of practice. So let me explain you. Looking at the question, just on calculator you can solve it. So what is the data given over here? Current market price of the share is given as 400. 1 year call option is available at exercise price of 440. Risk free rate of interest is given as 10% per annum. Probable market price at end of the year will be, there are two probable market price given, LPP and HPP. LPP stands for lower probable price, HPP stands for higher probable price. LPP is 360, HPP is 480. Determine the value of call option using portfolio replication model. Now, I'll tell you simplest of steps. Try to follow me. You first do one thing, you find the gap between the lower probable price and higher probable price. What is the spread in the price? So, if I ask you to find the difference between these two without using a calculator, you can say 480 minus 360 will be what? 120. Spread in the share price, you keep aside 120. Then find what will be the value of option under both of these scenarios. Mind it, you are holding a call option. Call option has a strike price or exercise price of 440. After 1 year, when the option becomes exercisable, if the market price is low, that is a lower probable price is prevailing, that is 360, you are holding a call option, right? You will not exercise the option, because a call option is exercised only when the market price is greater than the exercise price. Exercise price is 440. If the market price is dropping to 360, you are not going to exercise your call option. You will let it lapse. The moment you let it lapse, the value of that option becomes 0. The value of the option at this point is 0. Value of the option when the price goes up. Let us find what will be the value of option when the price goes up. When the price is 480, that is market price is 480, but exercise price is 440. So we find that market price is greater than exercise price, you will definitely exercise the option. What will be the value of that option that time? Market price minus exercise price, MP minus EP. So market price is 480, exercise price is 440. Find the difference, difference is 40. So value of option at this price is 40, value of option at this price is 0. So what I have done by far, I have taken two probable prices, lower probable price and higher probable price. Gap between the lower and higher probable price is 120, correct? 480 minus 360, 120. At 360 the value of option is 0, at 480 the value of option is 40. I repeat, at 360 the value of option is 0, at 480 the value of option is 40. Now find the spread in the option value. 0 and 40, gap is how much? 40. 360 and 480, gap is 120. So spread in share price is 120, spread in option value is just 40. Now what you do, you take a ratio of spread in share price divided by spread in option value. Spread in share price is 120 divided by spread in option value, that is 40. 120 divided by 40 will give you 3. That means if you want to create a replica, for every one share you create a portfolio of 3 call options. So if you have 100 shares, you have 300 call options. If you have 500 shares, you have 1500 shares call option. The number of call options should be 3 times the number of shares. One thing done. After doing all this, now see what you have to do. You compare two things now, lower probable price and exercise price. Lower probable price is 360, exercise price is 440. You identify whichever is lower. So you identify whichever is lower. So 360 is lower. So you pick whichever is lower. Now you find this is the lower probable price, means this will prevail at the end of the year. Find the present value of this. So for present value we need interest rate. Interest rate is given as 10%. Time horizon is 1 year. So 1 year discounting, 360 divided by 1.1. The present value comes to 327.27. 327.27 is the present value of the lower probable price. Compare that with the current market price. Current market price is 400 and present value of lower probable price was 327.27. From 400 subtract 327.27, you get 72.73 as the difference. That difference is the value of 3 call options divided by 3 and you get value of each call option as 24.24. Task done. It took some time for me to explain because you might be hearing this for the first time. I want you people to respond in the comment section whether you have learned this earlier or is it for the first time you are learning this. If you are learning it for the first time or you have learned it earlier, please do mention it, because I am going to repeat this process now little faster. See how to do this calculation from the scratch. First thing what I have done, I took the spread in the share price, 360 and 480 difference. So 480 minus 360, spread in the share price is 120. Then I found that at 360 being market price, option will not be exercised because its exercise price is 440. So when the option is getting lapsed, value of the option will be 0. When 480 is the market price, option will be exercised, its value will be MP minus EP, that is 480 minus 440, value will be 40. So value of option at lower probable price is 0, value of option at higher probable price is 40. Spread between the option value is gap between 40 minus 0, that is 40. So spread in share price was 120 divided by spread in option value, that was 40. 120 divided by 40 gives you 3. That 3 indicates that you should have 3 call options. These 3 call options you park aside and now do what I say. You pick lower probable price, that is 360, and compare that with the exercise price. You take exercise price or lower probable price, whichever is lower. So 440 and 360 compared, lower of the two is 360. So pick 360 on your calculator. Find the present value of this 360. So 360 divided by 1.1, what you get is 327.27. Compare this with the current market price of the share, which is 400. So 400 and 327.27. Find the gap between the two. So the gap between the two is 72.73. This is the value of 3 call options. How we got that 3? Spread in share price divided by spread in option value. 120 divided by 40, that was 3 call options. So 72.73 is the value of 3 call options. Value of each call option will be 72.73 divided by 3. Your answer is 24.24. So I have asked you to put in the comment section, and what I can see, many people are mentioning that it is the first time that they are coming across this. What happens? The whole world is crazy behind application through binomial model, because binomial model, it's a formula based calculation. You put values in formula, you get the answer. You don't have to do all this. Now the whole process that I have explained, again that whole process has a logical explanation. It is not something that you just blindly do it. It has a logical explanation. It has a complete rationale behind this. So as I told you, in this limited time I will not be able to go that deeper, but if you are interested, you can let me know and I will help you out. Definitely I'll give you link of video, or I can stream a video for you separately apart from these discussions. I'll help you out definitely, but you should mention if at all you are interested in learning the logic behind this. What has to be done, I have explained you. Let me put forward the solution in front of you. So what we have noticed, first step, spread in the share price, which is 120, then spread in the option value, that was 40. How we got 40? You will have to show it as a working. So in this working, look at one thing, value of option when exercised, it is MP minus EP. Don't forget it's a call option, that is why its value is MP minus EP when it is exercised. So probable price when it is 480, the call option will be definitely exercised and its value will be 40, that is MP minus EP. 480 minus 440, that is 40. If lower probable price prevails, you will let the option lapse and its value will be 0. That is why the spread in share price will be 120, but spread in option value will be 40 minus 0, that is 40. So spread in share price was 120, spread in option value is 40. Next thing what you do is you take this ratio, spread in share price divided by spread in probable option value, and that would give you 3 call options. Thereafter what you do, you create this equation. As I told you, you take present value of lower probable price or exercise price, whichever is lower. So it will be present value of 360 or 440, whichever is lower. So because 360 is lower, I'll take the present value of 360. So present value of 360 will be basically 360 divided by 1.1, and that becomes 327.27. That will be compared with 400. The difference between these two will be the value of 3 call options. So difference between these two will be 72.73, which is the value of 3 call options. So value of each call option is 24.24. See, this formality of writing down this entire solution is something different, but on your calculator you can literally approach this calculation if you have enough practice in just 1 minute, once you have practiced, once you have mastered these calculations. So if you are interested in taking the screenshot of this, let me help you with that. This is the first slide of the solution. So quickly take note of that. You can take the screenshot. Do it quickly so that I can take you ahead. Done. After this, the working note, here it is. Take the screenshot for this as well. Once done, the third step is to find that ratio, that will be spread in probable share price divided by spread in probable option value, which gives you 3 call options. Note it down. That means take the screenshot for this as well. And then this is the last part of the equation, which I have explained you what you need to do. Take the screenshot for this as well and let me know when you are ready to move ahead. I want you to write in the comment section if you are really interested in knowing the logic behind these steps. Please do mention. Have you taken the screenshot already? If yes, I will take you ahead. Now, let us move to another question where I'll show you the application of binomial model. A binomial model goes with this kind of formula. And in the binomial model, when you see that formula, how to apply that formula, I'll explain. I'm giving the same question reference, that is, use the data given in question 17 and determine the value of call option using binomial model. So what was question 17? I have displayed again, same question, but that question you have solved earlier using portfolio replication model. Now we are targeting solving the same question through binomial model. How do we do that? You write up the formula and you define all these variables, put the value of these variables in the formula to get the answer. So C is the value of call option at present. So this is what you have to find. Okay, this is what you have to find. CU is the value of call option when the price goes up. So when the price goes up, the higher probable price was 480. At that time, the option becomes exercisable because exercise price is only 440. The value of call option becomes 40. We have already understood this calculation when we were discussing portfolio replication model, correct? What will happen? CD, CU means value of call option when the price goes up, U for up, D for down. So CD indicates the value of call option when the price goes down. CD, value of call option on expiry when the price goes down, it will be 0 because the lower probable price was 360. If lower probable price is 360, exercise price is 440, definitely you will not exercise your option, you will let it lapse, and that is where the value of option becomes 0. Then this capital I is 1 plus risk free interest rate. So it's basically the future value factor. So if 10% is the interest rate, 1 rupee of today will become 1.1 after 1 year. That I what you find over here is the future value factor. Then U is what? 1 plus rate of return when the price goes up, and D is 1 plus rate of return when the price goes down. Alternatively, you can define this U as higher probable price divided by S0. Now what is higher probable price? 480. And what is lower probable price? 360. So U can be found as ratio of higher probable price divided by spot price. Higher probable price was 480, spot price is 400. So 480 by 400 will give you 1.2, and D is lower probable price divided by S0. So D will be 360 divided by 400, that will be 0.9. So we got the value of U, we got the value of D, we got the value of I. So within brackets over here, it is I minus D divided by U minus D. This side it is U minus I divided by U minus D. Putting these values over here, and CU is 40, CD is 0. So when we substitute all these values, what do we find? When we substitute all these values, I'm just repeating the formula so that you can understand the reference. So all the values I have substituted now in this formula. Look at this. 40, CU was 40, CD was 0. Capital I was the future value factor, that was 1.1. So wherever it is I have put 1.1. U was 1.2, D was 0.9. And once we make this calculation, let us do this. I will not be concerned to make this side calculation because this whole thing will become 0 because this whole ratio is getting multiplied to 0. So let us not concern ourselves with this. Focus only on this. 1.1 minus 0.9 will give you 0.2. 1.2 minus 0.9 will give you 0.3. 0.2 divided by 0.3 multiplied by 40 plus this whole thing will be 0 and then divided by 1.1. So it will be 40 into 0.2 by 0.3 plus 0 divided by 1.1. So pick your calculator and do what I say. 40 into 0.2 divided by 0.3, whatever you get, adding 0 doesn't change it, divided by 1.1, that will be 26.67 divided by 1.1. The answer will be same what you got earlier, which can be concluded as value of call option 24.24. So please identify and conclude this. See, if you see your curriculum, it's huge. In this limited time, whatever I could explain to you, I have attempted that. What I would want you all to do is, if you are interested in learning these concepts in detail, and parallelly you don't want to spend any amount for your learning, what you do is you just call at our office number, talk to my team will help you out. You have my office number with you, okay? If you want, I can share it right away. Just a moment, just a moment. Just a moment. Learning derivatives in detail, or learning the entire syllabus in detail, if you are interested, just call at this number. Tell my team that you have been one of the candidates from CMA final exams attempting now and you need some help. My team will definitely help you out. So based on lots of responses that I have got, so few things that I can commit to you definitely, that if you are interested and if you have time in going into depth of option valuation, there is a lot to learn. You have a lot of option payoff type of questions, you have different strategies within options to learn. So if you are interested, you just mention this and we will see what best help can be done, what best help can be rendered to you. What we will do tomorrow, we have one more session, in fact two more sessions tomorrow, one in the morning, one in the afternoon, based on the strong request that I have been receiving from various students. Two topics have been requested a lot. One was capital budgeting. So as I told you yesterday, at capital budgeting basic part, at least you do from the playlist that I have shared in the group. I have placed a playlist for CMA final on my YouTube channel also. The basic part of capital budgeting, I cannot afford to spend that much time. I have already put those videos on YouTube channel. You just watch those videos and prepare the basic part. The advanced part, we can have some good discussion about that advanced part in the class. So just do the needful with respect to the basics of capital budgeting. Tomorrow when I have these two sessions, in one of the sessions I'll be taking capital budgeting, in another session I'll be taking as much possible as discussion on forex topic, so that two topics I would want to further touch. One will be capital budgeting, one will be forex. So as of now I'll be putting an end to this particular session. So please join the session which is upcoming, that will be tomorrow's session, and I'll plan and put that live stream scheduled, and depending on whichever topic you are interested in attending, one session will be for forex, one session will be for capital budgeting definitely. So fine, with this I'll be putting an end to your sessions, and thank you so much for attending this class.